So, put in 100, you got 200,000, you get that equity back, and we say, hey, we're selling the property, but you have the opportunity to roll 1031 exchange into something else and defer the gain. So we've done that before with our investors, and also we've done entity sales where we're able to defer the capital gain as well, because we want to give our investors, we want to keep your money working really hard, and we want to keep it we want to work it tax efficient.
And then you also have what's called the tax flow benefits, right? Where you guys do cost seg studies for the depreciation, which could offset a lot or a majority of that cash flow along the way. However, what happens when the exit? Are you guys typically just buying another property and then people are putting a lot there and doing some of that cost seg? And all those, although cost seg looks like they might be, to get the bonus back up again, right? For the 100%. Talk a little bit about just the tax flow aspect of investing with you guys.
Yeah, so our goal for our investors is to defer their taxable gains as long as possible. So the things that we've contemplated doing and have done, drop and swap is a great methodology. So if you if we're selling a property, we've given our investors the option to 1031 exchange into something else. So put in 100, you got 200,000. You get that equity back, and we say, hey, we're selling the property, but you have the opportunity to roll 1031 exchange into something else and defer the gain. So we've done that before with our investors, and also we've done entity sales where we're able to defer the capital gain as well, because we want to give our investors, we want to keep your money working really hard, and we want to keep it we want to work it tax efficient. So those are some of the things that we've done to provide our investors a tax deferral strategy when things sell. But then also bonus depreciation. We do cost segregations on every property we buy, and we fully bonus depreciate it within the first year. And this year it's 60% of the short-term life. And hopefully Congress finalizes that tax bill that brings it back. I think it made it through the House, and hopefully I think it's made it to the Senate, or it's close. But anyway. That's something that we do to, basically provide investors with the most tax efficient strategy as possible.
Yeah, I think so too. And we're hoping it does get through all of the powers that be. So the 100% bonus comes back, because that's a powerful way to build wealth where you can sell any asset of any kind and essentially invest in real estate property. And then be able to defer that capital gains taxes, because you get that passive loss. Now you got to be careful with passive versus active. There's some stuff there, right? So check with your CPA. But generally speaking, passive is with passive, and then cost seg is a way, if you're investing passively, to offset that capital gains taxes. Might also be active, right? Any thoughts on that, or do you know if it's both?
Yeah, so I guess to your point, I think it's a very complicated topic, but to simplify it as much as you can, passive income is just that. It's passive income. The income that you earn from the losses that you get from depreciation and the losses you get from these investments usually can't be offset against your active income. So if you're doctor, lawyer, pilot, attorney, engineer, whatever, that's active income. And so the passive losses you receive from these investments you usually can't use against your active earned income. And again, I'm not a tax or a CPA, so please do your own research on that. But if you're a real estate professional, if you're a real estate agent or you're a real estate developer, and most of your income is earned from doing real estate, you can qualify for the real estate professional status. 750 hours, 500 hours of specific interest in the real estate market. And again, check all this stuff. You can tend to be a real estate investor or active real estate, and if you qualify, you can use that against your active income. And even if that's you file joint, or if you're married to a spouse. But generally, most of our investors, they're high net worth, high income earners, and they're not they're not real estate professionals, and passive income can be used for passive activities. So.